All right. I'm J-Rod and welcome to Stocks That Rock. If you've been watching my videos for a while, you know I'm a pretty optimistic guy. Over the last few years, I've uncovered hundreds of bullish breakout stocks and cryptos here at Rich Retirement TV, even when the markets tanked in 2020. But on April 4th, the Treasury markets flashed one of the most reliable signals of a coming recession. I'm talking about a signal with an 80% accuracy rate of predicting a recession within 2 years. It's called a yield curve inversion, and it's kind of a big deal in a negative way. If you're scratching your head right now, don't feel bad. Most people don't have a clue what this signal means or even that it flashed this month. So in today's video, I'm going to break down the dreaded yield curve inversion and show you exactly how to protect your retirement savings from what could be a fast approaching recession. So what exactly is a yield curve inversion and why did it happen? Well, the yield curve is simply a list of spreads between different Treasury bond yields. And these spreads can help tell us in what direction the economy is headed. The most closely watched yield spread in the market is the one between the 10-year Treasury and the 2-year Treasury. If the markets expect growth over the next 10 years, then the spread should be positive and rising. If growth is expected to weaken, then spreads will likely fall, which we call flattening. When the spread goes below zero, we call that an inversion. Easy enough, right? The 2-year Treasury is a key bond to watch because it follows the expected path of the federal funds rate, which the Federal Reserve controls. And because the Fed is gearing up to raise interest rates faster than they have in decades to fight inflation, the 2-year yield has soared past the 10-year. And the 2s10 spread has sunk dramatically in the last year, falling below zero for the first time since August 2019. That tells you the smart money is betting on weaker long-term economic growth. So, why is this signal such a big deal? Because nearly 80% of the time the curve inverts, a recession occurs within 2 years. In fact, the average time until recession is about 16 months from an inversion. So I know all that sounds really bad, and over the long term, it is. But now, if you're ready for the good news, I'm going to show you how to protect your retirement savings from getting rocked and rolled. I ran a quantitative study on the performance of stocks and gold following yield curve inversion since the 1960s. From the point of a 2s10s inversion, stocks are the place to be for the next 3 months. Since 1965, the S&P 500 typically gains about 1.6% in the 1 month following an inversion signal. And it's positive about 80% of the time, which is actually better than its typical performance. And thanks to strong monetary stimulus coming from the Federal Reserve and Congress during weak economic times over the last 40 years, stocks have held up much better than they did after inversions during the 1970s, which was another period of high inflation and rising interest rates. But after 3 months, the S&P basically flatlines. The broad market index gains just 5% on average after a year from a signal, and it gains just 8% after 2 years. That's less than half the S&P's average performance over each period of 9% and 18% respectively. So at 3 months out from the April 4th inversion this year, you may want to start trimming your stock holdings and moving into gold. Why? Because after the last 2 inversion signals in 2005 and 2019, the Midas metal soared after 6 months, and it outperformed stocks handedly over the following 1-year and 2-year periods. In fact, after the 1978 inversion, the price of gold tripled after 2 years. But if you dive into gold right after a signal, you're probably going to underperform stocks for 6 months or so. So you definitely want to stick around in stocks for a bit before swapping out. Here's the bottom line. Yield curve inversions typically signal recessions, but if you start trimming your stock holdings after 3 to 6 months and hold gold 6 to 24 months after an inversion, you should do pretty well over the next 2 years, no matter which way the economy goes. Thanks so much for watching today's video. As always, if you dig the content, please hit the like button and subscribe to the Rich Retirement channel here on YouTube so you never miss out on my videos. And if you've got a question, comment, or a topic idea for a new video, leave a comment below this video or shoot me an email at askjrod@stpaulresearch.com. Thanks again, and for Rich Retirement TV, I'm J-Rod, and I'll see you next time.